So we're still on idea number 2 on how to reduce your passive income and therefore protect the small business deduction limit that you have. So idea 2 still being, let's get the money out of the corporation and into your hands personally. So this idea is through the use of an individual pension plan. So for the purpose of this video, I'll use the lingo IPP. Individual pension plans are commonly known as IPPs. So we will do a longer form video with a case study, but I will try to keep this as simple as possible for the purpose of this video series. So an individual pension plan is basically a pension plan, follows the same rules as if you had an employer with a pension plan at work as well. So there's an actuarial calculation that we would go through in order to determine how much you could deposit into an individual pension plan for yourself. And the reason why this works well is that the limit is usually higher than it is with the RRSP contribution room that you have. So what you want to do is we always want to maximize RRSPs first and then look at the available contribution room to an IPP. So another benefit is that this is a tax deduction to the corporation because they're making a contribution to a pension for an individual. And to you, it grows in as a pension plan. It follows the same pension rules as any pension in Canada. That is one of the downfalls. And it's invested in a pension plan, gross tax deferred, therefore for you to use later when you retire. So let's get into some of those downfalls. One of the downfalls of the IPP is that it does follow pension rules. So once it's in this plan, you can't necessarily pull the whole thing out lump sum. So you have to follow pension rules, minimums and maximums that can be pulled out every year. The other downfall is that this will increase your fees in your accounting and whatnot, because what you need to do is you need to follow the pension rules, which means you need an actuarial review of the individual pension plan every year. And if you fall short, so let's say there's a market downturn and the pension becomes underfunded, just like any other pension, you may have to add contributions to the pension plan to make up the shortfall. Now, although that's a negative, this could be a positive because you only have so much room. Markets down, pull more money out, put it into the individual pension plan. When markets are down, they go back up. So that actually could be a pro because it allows more money to go into the pension plan. So we will get into a case study, but this is a fantastic way in order to get money out of the corp into your hands personally. This will help with passive income and the small business deduction clawback.